Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. Prime Minister Narendra Modi flagged off the third Vande Bharat train on the 30th of September. And in the next 4 years, there is a plan to roll out over 450 such semi-high-speed trains. But in just 10 days since the launch, the nose of a train was disfigured twice due to collisions with cattle, while another Vande Bharat train faced a technical glitch. Against this backdrop, we ask today if our rail tracks and other infrastructure are ready for such a speed upgrade.
The Indian Railways is up for a major facelift. Railway Minister Ashwini Vaishnav has said this week that people will be able to enjoy the bullet train rides from 2026. He also said that the government will turn 199 railway stations into world-class stations with all modern facilities. So, as part of this broader plan, the Railways is also rolling out semi-high-speed Vande Bharat Express trains. These indigenously manufactured trains are also called Train 18. The first batch of Vande Bharat trains were rolled out in 2019, and now their upgraded version, Vande Bharat 2.0, has hit the rails. It can attain a maximum speed of 160 km per hour due to faster acceleration and deceleration. The new Vande Bharat trains are also equipped with advanced state-of-the-art safety features, including an indigenously developed train collision avoidance system called Kavach. But barely a week after Vande Bharat Express between Gandhinagar and Mumbai was flagged off by Prime Minister Narendra Modi, the train required a facelift twice in 2 days due to cattle hits. It also faced a technical glitch on Delhi to Varanasi route on Saturday. It was a snag in traction motor that jammed its wheels, causing a flat tire, which refers to the damage of the roundness of the wheel. All the passengers had to be deboarded and shifted to a Shatabdi Express midway. The Railways, in response to cattle hit incidents, said the replaceable nose cover is designed to absorb the impact without transmitting it to the functional parts of the train, adding the part was sacrificial by design. Railway Minister Ashwini Vaishnav provided a reality check. Interacting with students at an engineering college in Gujarat, he said collisions with cattle were inevitable until elevated rail tracks are in place. More than 32,000 animals, including cattle, lions, and leopards, have been killed on railway tracks between 2016 and 2018. Given that cattle runover incidents by trains are a regular feature, the Indian Railways is planning to keep spares of Vande Bharat's nose cones. The latest Vande Bharat trains are 38 tons lighter than its predecessor and hence faster. The nose of the train is made of fiber-reinforced plastic. The Railways is also reportedly planning to install fences along the tracks on Vande Bharat routes to prevent accidents. Experts say fencing is necessary to avoid such incidents once train speeds cross 120 to 130 km per hour. More so for semi-high-speed rail, as elevating tracks is a costly affair. Most of the 508 km corridor of India's first bullet train project between Mumbai and Ahmedabad will be elevated. With railway tracks passing through grazing lands, farms, and unplanned or illegal residential establishments, there are concerns over the practicality of fencing the entire network of tracks. A former Railways official told Business Standard that fencing would only work if alternatives were given to people for safer cross-track mobility, such as rail over and under bridges. In FY23 so far, the Railways has eliminated 213 manned level crossings and built 250 rail over and under bridges. It has said that there are no more unmanned crossings on its broad gauge network.
Infrastructure has kept pace. And see, one thing I can tell you, rigorous in case of train movement. Say first there is a design check, then there is a check by electrical inspector to government, then there is a check by commissioner of railway safety. They are all independent bodies, and rigorous trials, physical trials go into clearing anything and anything. So all those things are in place, and I can assure you, yes, they whatever say design. Now say one is the speed of the train is decided by many factors. What is the track on which it is going, what are the bridges are fit, and what is the rolling stock width, and the least denominator is what the clearance is given. So all those things are in place. So I will say that yes, whenever a train, whether it is Vande Bharat, whether it is Shatabdi, any train, whenever a train is introduced, the mandatory checks are there in the system for the independent bodies are gone through, and after that is taken, only then the train is introduced. So I can say to conclude, yes, infrastructure requirements are in place. So this project for upgradation of infrastructure to initially 200 kmph and then 225 kmph on the trunk routes is in progress. So Delhi, Mumbai, Delhi, Havra, it is in progress. So by this way, various measures are already in place. And secondly, say if in any case if you come across a section where the say a train can go at say 130 or 120, then it will negotiate at that speed.
Experts say that infrastructure is already in place to keep up with aspirations of Vande Bharat. However, fencing upgradations are required for semi-high-speed trains to avoid safety lapses.
Several European countries are now exploring the option to use renewable energy to fuel their trains. With the world trudging the renewable energy path, India too is keeping pace with it. But wind power, which had a head start in India, has reported moderate growth in the last few years, with solar dominating the renewable energy mix. Why is it so? Let us find out.
The answer to India's renewable energy targets lies in the wind, literally. And India knew it way back in the 1980s when it had started investing in wind power development. And this form of renewable energy enjoyed an edge over solar over the years. For instance, in 2014, wind power's installed capacity was about 21 gigawatts, while solar's installed capacity was just 2.6 megawatts. Wind power currently contributes 10.2% of total installed capacity and makes up for 37% of renewable energy mix. Businessman Tulsi Tanti, who passed away recently, contributed in a big way to India's wind energy space. His company, Suzlon Energy, currently over 100 plus wind farms and an installed capacity of 13 gigawatts in the country. India's total installed wind capacity stands at 41.2 GW. Suzlon develops some of Asia's largest onshore operational wind farms in states like Gujarat, Rajasthan and Tamil Nadu. To give a leg up to the industry, the government also gave financial incentives such as accelerated depreciation benefits. A portion of the project cost was repaid by the centre. It also gave generation-based incentive where wind power producers would get an incentive of 50 paise on each unit of power generated. Then there were also subsidies and customs duty exemptions on certain wind electric generators, while other incentives include waiver of interstate transmission charges for wind projects commissioned before 2025 to facilitate interstate sale of wind power. India has an ambitious goal to meet 50% of its electrification requirements through non-fossil fuels by 2030 with installed renewable capacity of 450 GW. India constitutes 31% or 140 GW of this target and hence a crucial link for India's sustainable goals. But over the years, wind energy could not keep its momentum. Solar power installed capacity has increased by a massive 2,063% since 2014, while wind installed capacity has risen just 93% during the same period. One of the reasons was the introduction of a competitive-based reverse bidding auction where bidders keep the bids lower to win projects. Under the earlier feed-in tariff mechanism, power price would be in accordance with the project cost. The tariffs fell from 4 to 5 rupees per unit to 2.5 to 3 rupees per unit after moving to auction, according to a parliamentary panel report. In fiscal 2021, solar tariffs ranged between 2 to 2.2 rupees per unit. Competitive bidding at low tariffs led to concentration of projects in only 2 states of Gujarat and Tamil Nadu, where wind speeds are higher. This has put pressure on land availability and power evacuation infrastructure in these states, leading to delays in project commissions. For instance, there have been delays in commissioning of Bhuj 2nd, Cham-Khambhalia and Tirunelveli extension projects in 2021.
The second main reason, in my view, is that after wind moved to competitive bidding in 2018, the tariffs went down very aggressively, and on the other hand, the costs started inching up after 2019-20 onwards. And unlike again in solar, where you have anything between around 50 to 60 suppliers spread over India and internationally, in wind, the number of suppliers is much smaller. In India, we always say that we've got enough and more wind supply capacity in India, the turbine supply capacity. But the reality is that most of the Indian turbine manufacturers, in fact, even the international ones, have been facing deep financial trouble challenges because the costs have gone up, but the turbine prices have not kept pace. So the result is that many of the Indian companies have actually gone out of business, or they've even shut down factories, whereas the international companies like Siemens Gamesa, GE, etc., are either using their Indian factories for exports, where they get much better prices, or they are basically expecting and negotiating higher prices for their projects. So the supply side has become really constrained. The prices have moved up. The tariffs over the last 3 to 4 years have not really been viable. It is a result of all these things that the sector has really slowed down.
Payment delays from power distribution companies also led to troubles for wind power companies. According to a CRISIL report, debt worth 30,000 crore rupees for wind power projects faced stress due to payment risks from discoms as of January 2021.
Government should do away with the reverse auction thing. We should have a closed bid pattern. Let's have a formula that, okay, there will be no reverse auction. You give a closed bid and whoever is the lowest wins it, and a bucket filling method. In which case, we will not have a compulsion to see and go for aggressive bidding. People will be more rational in bidding. And over a period of time, say in 1 or 2 years, once we discover a price for wind energy, that we know that a stable pricing is between around 3 rupees, we can fix that tariff and let people put up wind projects at 3 rupees. Let me tell you this, we can add at least 10 gigawatt annually if we fix a tariff of 3 rupees for wind energy. That is the way to go forward. And if we have to do 500 gigawatt by 2030, current wind energy is around 40 to 43,000 megawatts. We can add another 50,000 megawatt by 2030 if we fix a tariff and move forward in wind sector.
The government has recently announced to scrap reverse bidding auctions for wind projects, which came as a breather to the industry. In 2021, the Solar Energy Corporation of India awarded 2.4 gigawatts of standalone wind tenders, which were then oversubscribed in contrast with the past 2 years, when the subscribed volumes for standalone wind tenders were 50 to 80%. According to a Wind Energy Outlook report by GWEC, India is expected to install 19.4 gigawatts of wind capacity in the next 4 years. If this figure is realized, the country can add around $10 billion in direct and indirect gross value added to the economy, the report said. If nurtured with proper planning of transmission, harnessing offshore wind and hybrid projects, wind energy can provide the right balance for India's energy needs and accelerate the country's shift towards net zero emission.
Moving on to markets, soaring inflation and steep interest rate hikes deployed by global central banks have brought an end to a 4-decade bull market in global bonds. However, Indian bond markets have been relatively resilient and have seen single-digit cuts since their recent peaks. As strong labor markets in the US suggest more rate hikes, will Indian bonds break under the mounting global pressure? Here's a report.
The hawkish monetary policies of central bankers pushed the global bonds into their first bear market ever last month. The Bloomberg Global Aggregate Total Return Index of government and investment-grade corporate bonds has dipped over 20% below its 2021 peak, the biggest drawdown since its 1990 inception. While bear markets are common in equities, they have been unheard of in bond markets as the asset class emphasizes reliable returns over a period of time. Bond prices are inversely related to bond yields. And as money market watchers factor in higher interest rates, especially after last Friday's solid jobs report in the US, yields on US treasuries are set to climb further. They are already near 4%, their highest level since October 2008. In comparison, yields were around 1.7% at the beginning of 2022. Back home too, analysts are cautious on the returns expected from Indian government securities. However, the sell-off in Indian bonds hasn't been as cruel as seen in the global markets. From their last year's peak, the Nifty 10-year G-Sec index had fallen around 5.5% till June this year. The index climbed again only to resume the sell-off mid-September onwards. As per Sujan Hajra of Anand Rathi Shares and Stock Brokers, a lot of factors are going against the Indian bond market. Elevated inflation, continued monetary tightening by the RBI, sharp reduction of system liquidity, and record high bond holding by banks, which may result in subdued demand and/or bond sell-off by banks, are key overhangs. That said, analysts believe the marginally lower than expected H2 FY23 borrowing program will provide some relief to the bond markets. Moreover, relatively less hawkish Indian monetary policy, steady buying of bonds by banks despite excess holding, much better tax receipts could support the domestic bond markets on a relative basis. Economists see yields on 10-year G-Sec rising to 7.5% to 8% by March 2023. Against this backdrop, how should fixed income investors shape their portfolios?
So wherever in the portfolio of an investor there is duration present, whether it is through buying long-ended corporate bonds, G-Secs, or being invested in mutual funds which run a very high modified duration, the idea would be to actively cut exposure to the same. The second step would be to avoid volatility, and this could be done by not being exposed to open-ended schemes and open-ended investments, and having a much of a lesser MTM impact in your bonds, and to not run leverage positions through margins if the investor is investing in international bonds, to sort of try to book profits or cut losses as the case may be. Incrementally look at allocating to FMP products, as well as looking at close-ended solutions per se. The third step would probably be to evaluate accrual as a strategy, because that's where once you go underweight duration, there's always an opportunity to make a decent profit through accrual strategies. And given that curves are inverted, there's a good opportunity to go ahead and make accrual income into the portfolio.
Irfan of Vivriti AMC suggests investing in corporate bonds of companies having strong domestic linkages, or those that have less exposure to imports or currency fluctuations. In nutshell, while the downside risks outweigh the upside possibilities in bond markets, the outlook of domestic G-Sec look relatively robust versus most global peers. On Tuesday, investors will react to Q2 earnings of TCS and oil prices, bond yields, and IPO of Traxon Technologies.
India had introduced a pre-packaged insolvency resolution process last year. It was projected as an alternative resolution process for MSMEs. Our next report has more on that.
It is a state when a business or a person is unable to pay debts on time, and it often leads to a bankruptcy filing. Passed in 2016, IBC governs insolvency and bankruptcy proceedings for companies, partnership firms, and individuals. It subsumed several laws, such as the Companies Act 2013. Insolvency process under the Bankruptcy Code was a significant reform for resolution of companies facing financial distress. Even though it still has a long way to go, the Insolvency and Bankruptcy Code has managed to deal with over 2,000 cases, either through resolution or liquidation. Micro, small and medium enterprises or MSMEs are the backbone of the Indian economy. They generate millions of jobs, and the health of these companies is crucial for sustained growth. In the wake of COVID-19 pandemic, a pre-packaged insolvency resolution was introduced in April 2021 to deal with stress of these small and mid-sized companies. The idea was that resolution of distressed MSMEs requires different treatment due to the unique nature of their businesses. Pre-packaged insolvency process is an alternative and speedy resolution mechanism for micro, medium and small enterprises in financial distress. However, the scope of pre-packaged insolvency processes is larger than just COVID stress. It seeks to achieve quicker, cost-effective and value-maximizing resolution, and at the same time making it least disruptive for the continuity of businesses. The entire resolution process has to be completed in 120 days from the date of initiation. If the default amounts range anywhere between 10 lakh rupees to 1 crore rupees, the pre-packaged insolvency process kicks in. If the defaults are higher than the said amount, a corporate insolvency resolution process under the IBC would be initiated. Unlike in the corporate insolvency process, the pre-packaged insolvency process allows for an informal understanding between creditors and debtors. The informal understanding is the way of debt resolution of distressed companies before insolvency initiation. After 66% of creditors approve the informal proposal, the pre-packaged insolvency resolution process begins. However, only 2 cases have been admitted so far under the pre-packaged insolvency process, which is quite low. According to reports, the poor response for the mechanism was due to the hesitancy of financial institutions. In the corporate insolvency resolution process, haircut is a last resort, and in pre-packaged process, it is voluntary. Banks are reportedly not willing to initiate pre-packaged insolvency processes due to voluntary haircuts.
I will achieve, I will fly high. I am the MSMEs.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Over a year after its launch, the pre-packaged insolvency resolution process has got only 2 takers so far. That's all for today. For more news and analysis, please visit our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.